Today I just wanted to be quick. I know last week we talked about Lincoln Heritage. But the week before that we was into infinite banking. We started talking about it a little bit. So today all I really want to do is hop on Foster's and show you guys how to design it. All right, and this call recorded as well, so we can send this out so you guys can go back and watch it to do a step-by-step yourself, or you can always call into Foster's and they pre-sales and they'll walk you through it and design the case for you as well for whatever the case design is that you're looking for. Be able to do that. All right, but before I get into that, I can ask anybody. I know a lot of people sold over the weekend, help family. So, is there anything anyone wanted to share? Something good that happened over the weekend that would be beneficial to everybody, or does somebody had like a question that they ran into over the weekend? If so, you can just unmute while I log in. No, nobody. All right. All right, nobody got anything to share. All right, let me share my screen. All right, everybody can see my screen?
Yes, we see it.
All right. All right, so the companies, of course, that we went through last week, we do the infinite banking with is going to be National Life Group and Foster's. The reason being is those are the two companies that we have that pays a dividend for their whole life policies. Okay. All right. So when you want to design it, of course, we're going to go to illustrations, product line. It will be whole life that we're going for. Put your state in here. I'm in Pennsylvania. So we put the state in there as well. Boom. It's going to be Advantage Plus. I mean, the Advantage Plus tool. Now for infinite banking policies, they have to do medical. All right. They got to do medical just by the way going to have to design the policy. So everybody has to do blood and urine if they would like to do this. All right, it's real simple blood and urine steps. You call in to set it up, and then that testing center will call the client, and then they can either come out to the testing center or they can come out to the client house. All right, whichever one would be good for you. All right, but I'm gonna just keep all this the same. Of course, you put in people personal information there, but this is how you solve it. So you want to go to case design. Majority of the time, now this can change sometimes, but majority of the time you're going to go for this last one right here, FPUA, non-MEC turn right or solve. So what does this do? The government puts a limit on how much we can put into a policy, because all infinite banking is, we just overfunding the policy. Overfunding the policy, so most of the cash can go to the cash value, and that way they can borrow, and that would build the interest on there, right? So, but the government sets a limit on how much you can actually put into a life insurance policy. So, what the term rider do is it allows us to not MEC out. So we'll just increasing the term rider on there, so we can make the policy fits, right? And once you hit that, you can go to riders. Now, if somebody has a single lump sum payment that they have, if somebody have a single lump sum payment, we can put it in here. Let's just say if they was going to put in, let's just say they was going to put in $15,000, right? That would be in there. hold on. Matter of fact, because I want to show you guys it's not letting me do this. Let me see. I'm gonna do this because this is gonna be a lot of you guys. All right, we're gonna specify the premium soft. We're gonna go premium soft because this will allow you guys case is going to be. So what this is, because a lot of you guys, they have, let me let somebody in. Some people, you work on people budget to say, yeah, I can afford $500, $200, whatever the case may be. So this might be easier for you guys to put that in. Right. All right. So hold on. Hold on. Pacific Fire Premium fee. So you're gonna go down here to premium amount. Let's say the person can afford $300 a month. So you're just gonna put $300 in there. And then we go to writers, they all already putting 15,000 in there a month. Now this right here is the flexible payment PUA. So this is the portion of the monthly premium that's going to go into the cash value. I typically like to do 60-40. So 60% of the money is going towards the premium, the cost of insurance, all right, and then the 40% is all going to the cash value, right? So I forgot what number, how much I did put on here. All right, so 300, 60% of 300. All right, 120. All right, so we're gonna have 120 going into here. Now that's 60%. I mean, that's 40% that's going into the flexible PUH. This is the money that's automatically just go towards the cash value, right? And then we gotta have the term writer. We gotta fix that because you see it says it will mech in 1 year. So all this fix this problem is we just gotta keep increasing the term writer. So let's do like a $200,000 term writer. All right, it's still Mac after the first year. All right. So all that is just we just want to hit the key increase in this term writer right here until we get up to a point where the policy like don't mac out. I'm not sure why it's letting me hold up. It's probably because it's age. It's probably because it's age and how much money we're dumping in there that is causing that to do. So how about this? So how about this?
Does it matter how long the term is? Like right now it says term 10 years.
Yeah, I always typically do 10 years.
Okay.
I always typically do 10 years. All right, so let me see this. No, hold on, let me see. Oh, all right. So yeah, guys, you just gotta like play with this, honestly. But I'm not sure why it's pulling up like that. So see, if I had this problem, I'll just call them in. I'll just call up Foster's and then I'll get them to help me out with it. But hold on, I want to make sure. I want to get this to where. All right, see, it was the age. All right, so now we got it to we got it to work. So this would be, how about I'm gonna just pull up the illustration for this, and then we'll be able to see it exactly. Yeah, unmute if you guys got any questions. Does anything happen when the 10 years is up? No, the term just drops and the premium gets lower, right? So all right, we got 4-year-old male. He's going to be paying $300 monthly in total. Instead of the 15,000 up front in 1 year, I broke it down to 7,500 in the first year, 7,500 in the second year. So that's still the 15,000 going into the policy, but it's just not all in one lump sum, right? All right, so the original basic insurance that he has would be $123,000, right? That's his whole life death benefit. He's paying $156 towards that. All right, that's how much that costs for there. That's where you see that's where that comes in at, right? The 10-year term rider that I added on for 300,000, that's going to be $23.36 a month. All right, so that's why his initial premium is 180. All right, now we only get paid on our initial premiums. So when we talk commission, we're not going to get paid on the whole 300. We're only going to get paid on the initial premium, which is the 180. That's 60%. Okay, because we only get paid for the cost of insurance, because that other 40%, that's only going to his cash value so that can build. Okay, so there's no that. So the other 120 that he's paying is just going to go to the paid up edition riders. The paid up edition riders, it goes towards the cash value and also increase those living benefits that he has for the critical chronic terminal illness injury. So it increased those benefit payouts as well. All right, so that's the breakdown of any questions on that before we go into like the illustration part of it. No? All right. All right, and this what it would look like for him. This what it would look like for him. You can see after Jazz, to answer your question right here, you see how his premium was 11,100 each year, and then it drops after the 10-year mark. So that's all that happens. The term rider drops off, and then you'll also see the death benefit drops because the term rider is off. He no longer has that $300,000 10-year term rider, so it drops.
Hold on 1 second. I'm trying to. I can't see what you're talking about. Okay.
You say you can't see what I'm talking about? So you see,
I'm trying to enlarge it. Yeah.
you see the contract premium, right?
Yeah, I see it.
All right. So this is his month. This is his annual premium.
Okay,
right?
11,000. Yeah.
11,100. The first one is because we added the dump in, but the 11,100, right? That's his premium. So once year 10 comes, he's no longer paying for that term rider, what was $23 a month. So his premiums actually decreased $23
Okay.
a month, and that's where you see this decrease at. And then I say you can also see the death benefit drops from 700,000 to 500,000 because of the term dropped off.
Okay.
Okay, so that's what happens with the term rider.
And you only have to make it a term so it doesn't go into effect, right?
Yes, correct. So we want to avoid taxes. So if a policy MEX, then it starts to get taxed like a retirement plan, like a 401k, like an IRA. So it'll start to get taxed like that, and that's what we want to avoid taxes. All right. So to avoid taxes is we just bump up the term riders on there to give us a bigger death benefit in the beginning.
Okay. And my other question is that, do you know why particularly that it doesn't do what a traditional term does, as far as like once the term is over, the price increases?
So no, so a typical term works the same way. So you got the option to renew the term or not.
So when you outlive your term, like you have a term for 10 years, doesn't the premium increase?
No, you don't have to take on that term again though. The term can drop off. That's what I'm saying. So you're not still stuck in the term. Like soon as you got a 20-year term, once it's over, you can drop the coverage. After that, you don't necessarily have to pay that bigger amount.
Okay, and
That's a new contract.
this is automatically drops.
Yes, it's a rider. It's a rider. It's not a term policy. It's just a term rider on there. Same
Yeah.
way with how a children rider is. Once they turn 25 years old, they drops off the policy. Is the same way.
And afterwards that's dropped, it wouldn't change into a MEC. Why wouldn't it change into a MEC then?
No, it wouldn't change it. It wouldn't change to the MEC because we're not dumping in that large lump sum in the beginning, and then also because our original death benefit for him was only $123,000.
Okay.
That's not enough to handle that. So if you look at the 10 years, is at 500,000. At 11-year point, he actually has more death benefit than he did when we first started.
Yeah.
The reason why it continues to grow is because those dividends get paid out. When the dividends get paid out, they go on towards the death benefit, which you can see increase every year, and it's going to the cash value. How much money is going to the cash value each year? Of course, the dump-in goes. You can look right here, paid up at cash value. So this is how much money is going into that cash value each year into his policy. So you can see, like, after once you get like to the 10-year point, majority, like all of his money, he's putting in 11,000 in a year, and 10,000 of it is going towards the cash value. So literally after like the first 10 years, majority of the money is just going to the cash value. Majority of it is just going to the cash value. To see, like, it kind of get a little ridiculous there. So
okay.
Any questions on that, on the setup, or any other infinite banking questions? We can take a few before we close out the call.
Hey, Ab, what is MEC? What is that?
A MEC, a modified endowment contract. All right, so this is just called a modified endowment contract. So it's basically if it reached that, like, the thing is, the government put a limit on how much money we can put into these policies, right? Because if they didn't, a lot of people would just put their money into life insurance because it's growing tax-free, right? So they don't want to promote this all the way. Like, that's why these type of policies is not like promoted. Only like really wealthy people who use this. They don't push for this because you can keep your money here instead of keeping it in banks and things like that. Right. So that's why they set those rules up. And then if you do have it MEC, that's when you'll start to get taxed. Like it's a 401k.
Is there like a dollar amount limit, or is it like a?
It varies. It varies by your age. So it varies on how much you're able to put in, how much money you can actually put in for the insurance. Because remember, we overfunding it. Remember, we overfunding the policy, right? Because his policy really only costs $180, right? His policy only costs $180, but we overfunding it. We put in an extra $120 in there each month, so his money can grow faster and take advantage of those benefits. So we overfunded it. So that's why we gotta increase the death benefit so it don't MEC out. So it varies on how much we can put. That's why I said most of the time we probably going to like use like software to term writer, because we don't know what number is going to be needed, and neither do you call in the fosters. They won't know the exact number either. They'll just keep raising and keep increasing the term writer until it doesn't matter.
Okay.
But yeah, they won't even let you do the illustration if you're doing the illustration that MECs out anyway. So they won't even let you move forward until you figure it out. So you don't have to worry about like messing that up or doing that. So you'll be cool on that. Somebody else, any questions, or that's it? We can wrap up.
I don't have a question, but if you go back to the illustration, In 10 years for your cash value to grow that much, that's just insane. You're not going to get that at a bank where most people hold their money in a money market saving. The most they'll get there is 0.03%. But if you're looking at this, the total cash value in year 1 is 16,000. In year 10, it's what is that? 131,210.
Yeah, so
That's
that's
insane.
yeah, and this is they put in that 10 years, they put in $118,000. So this is how much they put in at year 10. The 118 and that's the 131 is how much inside the cash value as well. So yeah, we just continue to grow. So the point of these policies is like when you get to the when he gets to the 20-year mark, this was an actual person, he will have $320,000 inside his cash value, right? At this point, you're like self-financing. You can be your own bank. That's why hence it's called infinite banking, because now when he want to buy a home, he don't have to get a mortgage loan. He can take out a policy loan. If you want to buy a new car, he can borrow from his policy. So you borrow it from yourself and you self-finance it through yourself. And as you pay the money back into the policy just gets bigger and bigger and bigger. So this.
And I have a question.
Mhm.
I'm sorry. What premium? And I missed this. I'm sorry. What premium did you start him off with?
$300 a month. $300 a month. And then it was like around 8,000, 7,000, something like that we dumped into the first year.
First year, it was like
And I'm-
700.
And I'm asking because the first column is the premium that he pays per year annually.
Yes, so this is the year that he's in. This is age. This will be his age. Yeah, this is the AP that he will pay. Right here is the guaranteed cash value and guaranteed death benefit. So this is if no dividends is never paid out. This is what that policy would be. But fraudsters, they haven't missed a dividend in over 100 years, so we can kind of like guarantee that they are going to pay a dividend, right? So that's what that is. And then, like I say, here goes your paid up added cash value, and then your total death benefit right there. Did that answer your question, Jess?
Yeah, I think I'm gonna call you, but yeah.
All right.
I had a quick question. So if someone is not doing a dump in, what's the minimum amount you would recommend to start someone in an infinite banking, like monthly amount, for it to make sense?
All right. So minimum, I like to say minimum 200 at least, because remember, we're not getting paid on the whole thing. So let's just say somebody has $100, right? And they say they want to do an infinite banking policy with $100. So remember, we do 60-40. So 60% of that 100, so $60 will go to the cost of insurance. Then the other 40 will go to the paid up addition writers, right? It will go right here. So you will only get paid on $60 worth of premium for that case. And then for that case, you're doing a lot because it's infinite banking. You got to do like 2 or 3 meetings. And then he also got to have he also got to take the medical. So you're looking at maybe about 3 weeks to get paid on the policy, and it will be a $60 premium that you'll be getting paid for. It's kind of like, is that worth your time and effort at that, right? Yeah. So yeah, that might not be worth your time ever. So that's why I say at least the minimum I do is $200 minimum is what I do.
Okay, makes sense.
That's just my base minimum. If you want to go lower than that, I mean, more power to you. But that's where that's the minimum that I usually take. But my average ones typically be around like $500 a month on average. Because you got to think, it's not more so about. I'm gonna stop sharing my screen. So it's not more so about how much this costs. It's more so about how much the client can save. So are they already saving on, you want to look for somebody that's already saving on the weekly, bi-weekly basis. If they already saving, where do you usually save your money? People typically save their money in savings accounts. Like Genesis, you just said it, like they earn like 0.2%. So if you got somebody putting $500 in that account each month, and then when they even do earn that 0.2% interest, is taxed on that growth too. So why not put it over here where you're going to be earning 3 to 6% every year and it's tax free? So your money grows a lot faster.
Yeah, so when they save on a CD, IRA, and things like that, they can take cash out when they're 59 and a half without being taxed, or you have to wait till you have a significant event, like you have to, when you get married, or if you leave a job, or if you have a baby. With this concept, you could take cash whenever you want. You just give them a call and you'll get your cash in 24 to 48 hours or something
Yeah,
like that.
about like 3 to 5 business days. It'll
Yes,
just
any
transfer
age.
right into your account. Right into your account in like 3 to 5 business days. Yeah, so it's more so about how much can the client save. So that's what these policies need to be geared towards. Like when you're selling these, is not, oh, how much can you afford to pay? Is no, how much can you save? Because this is going to turn into your savings account, where it can be your emergency fund. It can be your fund that pay for your taxes every year. It could be a fund for your family vacation every year. For real estate investors, this is where they put their large lump sum of money until they find a house to flip, then they take it out, utilize that cash, and then put it back after. So you're looking at like an opportunity type account, savings type of thing account as well. All right, but that's it. I'm gonna wrap this up, and we can talk about this more next week if you guys want to stay on this topic as well. All right, so everyone enjoy the rest of your day, have a good week, and let's close out this month strong.
All right. Thank you, Ed.
No problem.
All right, thank you.